On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. The official cash rate, or the OCR as it's commonly known, will soon be headed lower, and this will have really important implications for savers, borrowers, and investors. Financial markets have taken a bolder view on the timing of that first cut than most economists, and financial markets now see at least two, but possibly even three, 0.25% rate cuts before the end of this year. That could mean the OCR finishes 2024 at 5%, or even 4.75% compared to 5.5% today. Now, a move in October or November seems to be assured, but there's also half a chance the Reserve Bank might take a more proactive approach and cut the OCR as early as next month in August. Now, if that sounds outlandish and a little premature to you, let me just point out a couple of reasons why it's not completely out of the realms of possibility. For a start, the Reserve Bank's most recent estimate of the short-term neutral OCR, that's the level where it's not speeding up the economy or slowing it down. It's sort of that steady state OCR over the short term. The Reserve Bank's most recent estimate of that level is just under 4%. And because we're at 5.5% today, which is a whole 1.5% above that level, there's plenty of scope to begin the easing process soon, while still keeping policy settings above that neutral rate, which means they would still be in restrictive territory. We would still be slowing the economy down, albeit to a slightly lesser extent. Secondly, it's important to note that it can take several months, possibly longer, for policy changes to begin filtering through to the economy. So if the Reserve Bank wanted to provide some relief during the first half of 2025, if they wanted to take the pressure off, make life a little bit easier for businesses, for consumers, for the economy overall, it would actually need to make a move quite soon for that to actually hit the economy in early 2025. If you're a long-term investor, like most of us are, the exact timing is probably a moot point and it doesn't make a whole lot of difference. Whether you get that first OCR cut in 3 weeks' time in mid-August or in just over 3 months in early November or something in between, such as the October meeting, whenever it comes, the upshot is that the monetary policy landscape is about to change markedly. Now, one group who shouldn't be ignoring this are those income-focused investors that have been sitting back and enjoying the highly attractive term deposit rates that have been on offer. They have had a great run, but the clock is ticking now, loudly. If that group is too complacent, they'll not only miss opportunities elsewhere in other asset classes, but they could face quite hefty falls in income. At the moment, 6-month term deposit rates are sitting about the 6% level. That's the highest we've seen in 15 years. So if you've been lucky enough to have $250,000, $250,000 sitting on term deposit in a nest egg, it will have been able to generate for you $1,250 a month before tax, which isn't bad at all. However, that will soon change. If market forecasts for the OCR are correct, that 6-month term deposit rate in a year's time will have fallen from 6% to about 4.5%. And what that would mean is that your $1,250 has turned into about $940. That's a decline of about 25% in income over 1 year. A year after that, term deposit rates will probably start with a 3 compared to 6% today. That would mean that your $1,250 has fallen by 35 or almost 40%, from $1,250 a month to just over $800 a month. That is quite a big difference for someone who is reliant on their investment income. Savvy investors should be acting soon rather than sitting on their hands and letting that happen. Although interest rates across the board have come down over the last month, there are still opportunities to lock in quite reasonable yields from high quality fixed income securities or funds that own a basket of those securities. And investors can achieve maturities that will stretch out years rather than months, which means they are locking in that income for a longer period. The local share market could also attract more attention. In fact, it already has. It's been out of favour in recent years amongst high interest rates, but this month, July, it's actually rallied more than 5% so far. It's at a more than 2 year high, and it's on track for the strongest monthly gain that we've seen since November last year. And while share market indices in the US, UK, Europe, Australia, Japan have all hit new record highs this year, the New Zealand share market is still almost 20% below its all time high, which came in January 2021, more than 3 years ago. That's excluding dividends, just share prices in those indices. So our market isn't nearly as frothy or as highly priced as some others because it's still quite a bit below those previous peaks. And investor sentiment has also been much more subdued. Now, that's not a big surprise because the NZX is much more sensitive to changes in interest rates than many other share markets around the world. The sectors that dominate our market tend to perform very well, or better at least, when interest rates are stable or falling. And when monetary policy is tightening, they face more headwinds than we see in other markets. So the prospect of OCR cuts being not only on the horizon, but very much on our doorstep now, could mark a really important and relevant turning point for domestic shares. And that's in spite of the fact that we've still got a very fragile economic backdrop. Remember that many of our listed companies are stable, resilient businesses that pay reliable dividends, and they will look increasingly attractive, especially as income opportunities, as interest rates decline from here. Even some of the more challenged parts of the share market could start to be viewed more favourably. Some of those stocks or sectors that are a bit more beaten up, even though you've got a pretty lackluster earnings season coming up next month in August. Remember that share prices look ahead. That's why they've been in the doldrums these last 3 years. Investors have been correctly anticipating the recessionary conditions and the economic weakness that we're right in the depths of right now. And it'll be exactly the same on the way back up. The market won't wait for a recovery to be upon us. It won't wait until we're seeing evidence that the economy is back on track and that corporate earnings is heading in the right direction in a very obvious way. It will move well ahead of that as it sees it coming. So investors would be wise to do the same. You need to start positioning yourself now for an extended period of declining interest rates and a different backdrop that will come with that. It's a great time to talk to your advisor, do a bit of a spring clean of your portfolio, make sure that you are well set for what will be quite a different 6 months, 12 months, 18 months in the next period than what we've seen in the recent past. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.